We have not experienced the end of the banking problems, and this liquidity problem is really this credit issue. It's real, and it's not going away, and especially to a over-leveraged, undercapitalized banking system. I guess we'll have to go back to quantitative easing again, and that just exacerbates the sell-off of the back end of the bond market. You're trapped, in other words. Either you let the economy sink into a depression.
Banks are bracing for impact as liquidity vanishes and lending freezes. Today, Andy Schectman exposes the hard truth. Our over-leveraged banks are standing on a razor's edge. With commercial loans resetting to punishing rates and a key Fed support program expiring right after the election, will we see a chain reaction of bank collapses? Andy breaks down the dangerous choices ahead. Either sink into a recession or risk inflating the currency further. This could be the tipping point. Are we ready for what's next? Keep watching this video till the end.
Yeah, well, I mean, as it gets tougher, as liquidity dries up, banks, as you mentioned, they become reluctant, if you will, very reluctant to lend to one another due to that fear of insolvency. These banks are already over leveraged and undercapitalized, and they rely heavily on short-term funding. And when this liquidity tightens up and banks struggle to get the cash that they need, it leads to a freezing in the interbank lending. That's what we saw in 2019, to your point. And without these funds, banks are, they'll be forced to cut back on loans to businesses and individuals. And this, in a model, if you will, in a perfect world, this reduces overall economic activity. And then you factor into it. Of course, you also have what's called crowding out, which is the higher interest rates drives up or reduces the availability of credit to the private sector. And what you end up having is a contraction in economic growth because it's just too much money or it's too expensive to access money, and which leads to lower tax revenues. It's a doom loop. But in particular, this is something that when you add into it already the commercial real estate problems, the loans that are resetting, the majority of all of the loans, the mortgages, the credit cards, the leases, all of this is done off the 10-year. And so you push down the front end, which really doesn't do a whole lot other than make the short-term treasuries that we've shifted our lending or our borrowing to the short term, makes those a little bit easier. But in terms of what affects the consumer, it's pretty much the 10-year, which is going the other direction. And so you're going to have, as these commercial loans and leases reset in a slowing economy with higher interest rates, a strain on credit, it can lead to a cascade very, very quickly. And then you end up with what happened during the pandemic, where these banks, or the banking crisis rather, where the banks they needed cash, and so they had to sell assets quickly. Those were the treasuries that led to a collapse in the banks, that all of these assets were underwater. They had to be sold at distressed prices, and this is a very, very bad thing. That's when the Federal Reserve came in and injected liquidity to keep the banks from collapsing, these emergency loans like the BTFP, which we've talked about. And ironically, the BTFP expires November 6th, the day after the election. And I think when that happens, adding more fuel to a fire, we can expect to see a tightening of liquidity, of course, for the banks that have been depending on it. And particularly, this really affects the small banks, the regional banks. The regional banks are the ones that hold 70% of the commercial real estate loans. They're the ones that hold 70% of the small business loans. They're the ones that are getting clobbered. And so either the question then becomes, if the BTFP ends, is the Fed going to step in again when we see a strain in the banking system? And I think that's really the $6 million question. You could see a massive exodus, if you will, of deposits moving to the perceived safety of the larger banks. And I think you could see what happened in Lindsay, Oklahoma a week ago happen in spades. And I think that that's something people should really be watching as the liquidity really is being sucked out of the system. And with the ending of this loan program on the 6th, it's only going to add fuel to that fire. So we have not experienced the end of the banking problems. And this liquidity problem is really this credit issue. It's real and it's not going away, and especially to a over-leveraged, undercapitalized banking system that is about to really experience problems when all of these loans and leases and in particular commercial real estate loans start to and continue to reset over the next several months. Without that injection of cash that the Fed has been doing, I guess we'll have to go back to quantitative easing again, and that just exacerbates the sell-off of the back end of the bond market. You're trapped. In other words, either you let the economy sink into a depression, or you continue to do what everyone has done prior, and that is to inflate the heck out of the currency, which the bond market will sniff out, and which gold already is sniffing out. And I think that's why you're seeing these things happen concurrently. And this is when you get into systemic risk, counterparty risk, reinsurance risk. This is why they had to bail out AIG back then, because they are the ones that would sell all the credit default swaps, and the cascading of failures would very quickly blow up the entire system. And it's very dangerous. These derivatives where the value is based upon a counterparty's ability to perform, and in this environment, who knows what these counterparties' ability to perform truly is. So, yeah, I see tremendous risk as well, and you can see that by how high the credit default swap premiums are going up. Market sees it too. This is something that ultimately is inevitable to some degree. I mean, to some degree, you have to have a cleansing of the system and the continuing of papering over these problems that, in 2008, when all of this happened, the Fed's balance sheet was 800 billion. It reached 9 trillion a year ago. And that was all by purchasing interest rate sensitive investments like treasuries and mortgage-backed securities, both new ones and toxic ones, to drive down interest rates to smooth over these problems that really didn't go away. They just were hidden under the surface and growing and lamenting, and probably will only be worse when they finally exert themselves. But there is a structural problem within the banking system, and higher interest rates on the back end of the bond market will expose much of this very quickly, as these banks start to run into defaults from the loans, these bad loans that they have out there, which, with their walking dead companies, it's a real deal. And I think what happened with the bank in Lindsay, Oklahoma last week must be realized. And the interesting thing about all of it is that there's no word of it. I did an interview with Jay Martin yesterday, and he had no idea about it. And Jay's a smart dude. Jay is well connected, tuned in, works his butt off, studies hard like you and I do, Dunnigan, and he didn't know about it. Now he's in Canada. The point of it is that if a guy that's tuned in and plugged in and reading and researching and preparing for people he's interviewing, you would think that he would know. No, there is a specific plan or whatever you want to call it to not let this information out, but just enough to say we told you so. I would think that this is just the very beginning. You could say it's a slow fuse that was lit in Lindsay, Oklahoma, that we will see much more of as days and weeks go by. And it's very ominous and eerie that this BTFP ends on the 6th. You want to talk about rug pull? They could pull the rug right out from underneath it. And you look at the betting odds. The betting odds show that Trump is about a 2-to-1 favorite. And I think the betting odds are better than the polls. Vegas knows more than the polls do. And, you want to talk about letting all of this blow up on his watch. You want to get conspiratorial. Sure, I could see all of that stuff happening. I think it's going to only get crazier after the election, and the banks are a perfect tipping point to ignite that fuse.
If these insights from Andy Schectman opened your eyes to the risks facing our financial system, don't forget to like, subscribe, ring the bell icon, and share your thoughts below. Are we really prepared for what's coming, or are we all just bracing for impact? Thanks for watching, and stay tuned for more critical updates on the shifting economic landscape.